So the biggest piece of the new tax law that affects those pass-through entities is what's called the qualified business income deduction, or the QBI deduction. So what that is if you qualify for it, you get to scrape off 20% of your business income. So if you made $100,000 as one of those entity types, you only pay federal income tax on $80,000. The reason behind it, in addition to making people happy because they're paying less taxes, is because when they did the corporate changes, C corporations pay their own taxes. They cut the overall tax rate for those corporations. So this was to mimic this on the personal side for these pass-through entities. There are several restrictions to the 20%, so it's not just a guaranteed 20% off. You have to make sure you meet all these other requirements. So one is taxable income. So if that 20% chops off, you have to have income left for a tax to be able to chop off against. You have to have a certain amount of payroll if you have wages that you're paying out to employees. You have to have a certain amount of value of assets potentially. And then if you're a specified trade or business, there's additional caps. So specified trade or businesses are things like accountants, lawyers, consultants, places where they don't necessarily have a lot of cost of goods. They're not making something physical. They're providing a service. So they wanted to put caps on these services to ensure that they're not doing something to get around this piece of the tax law and be able to claim more of this QBI deduction than they should be. This is an enormous change for businesses because, again, it takes 20% off your income as long as you qualify for it right off the top. There's no other business deduction tax law piece that'll do that for a small business. So this was a big piece going into that new tax law, one to incentivize people to be business owners. Like, hey, you don't have to pay tax on all of your income to the federal government. You only have to pay it on 80% of that income. And also to get them to invest back into their businesses, to hire more employees, to buy more assets, to buy some new equipment, buy a new vehicle, instead of renting a building, buy a building. So there were a lot of that kind of stuff in the back end of what they were trying to do to incentivize people to open businesses, grow their businesses, and know they're not going to have to pay as much in tax to be able to do that.